So we've been at this about 25 years, and what we're going to talk about today is a topic that we found that entrepreneurs and business owners have really been attracted to. Because you are risk takers, you are used to running your own business, controlling your assets, controlling the risk you take. It's hard to diversify away from that. It's hard to say, well, I should put money elsewhere because I can produce a return in my business. And especially when you get to the point of a business transition and now the life work you've done to build net worth in a business and now it turns into cash, now what do I do? Most people think of the world as stock and bond only. We're going to talk about everything else but. So also because my life does revolve around the economy, we've got a topic I'm going to give you 5 or 10 minutes on. It's the value add. I think it's something you will hopefully find interesting. I've got charts and graphs for all this. Anybody that knows somebody as an economist, they know that's what their life's about. What I want to do is frame this in terms of how the macro economy, how looking at what's going on around us can impact my decisions as a business owner, even if my business is fairly local. There are trends occurring right now that are really easy to figure out, right? So I gotta tell you, is it difficult to forecast where the economy's going longer term? No, it's not. I don't know when it starts or the exact timing of it, but I can tell you what's coming because it's pretty inevitable. And we're in one of those stages now, so I thought we would add a little bit of it and talk about it quick and then go forward. So anybody right now trying to add or hire employees, and by show of hands, any of your businesses adding people right now? How's that going?
Not very well.
Right. So even on entry-level jobs, would you say it's still as difficult or more difficult than it has been in a long, long time?
More difficult.
So how are you getting them? Does it end up being more money, more higher wages, more benefits, or do they go longer for unfilled jobs, or how do you handle that?
Yes. Yeah, you have to do more. You have to do all of that, plus you still even have to have like flexibility. So you have to change hours, be very flexible, not just money. It's more than just money.
Would everybody echo that? I think you're 100% right. That's exactly what we see. Anybody have a different experience on that right now? Okay, so by the way, that trend, nationwide, did you know there's more open jobs today than there are people in the unemployment line to fill them? Did you also know there's an index called the Jobs Hard to Fill Index? It's the highest number it's ever been at in the history of the index. So how do you solve that? Two things, right? More employees, or you start stealing from everybody else and paying up. So if it's more employees, how are we going to do that?
Increase the labor force participation rate from 63% to back where it was at 66 by requiring people to work more.
How many people have millennials as children or millennials as employees?
Well,
How many of them would you say, and I got 4 kids, how many of them would you say have the same work ethic as you?
every generation said that, though.
Well, but I think this is very true in the sense that I'm not saying it negatively, but in terms of career versus personal life for them is higher. And so they're willing to work less, take less, to have a better quality of life. And I appreciate that. I put myself through law school, built a business. You know what? Yeah, I sacrificed a lot to do what I'm doing. Do I get why they do this? I do. So the problem that you have is that you got to overcome that. People also, as the economy's improved, have retired earlier again. So I'm seeing people retire in their late 50s, early 60s, now that we've been on this 10-year run. Where you are getting people, though, is people that have retired to work part-time. I think there's opportunity there. The other way, historically, in which we've handled that is immigration. So what are we doing about immigration right now? We're doing everything but that, right? So we've got a dilemma here that's not going to get any better. So, you know, mentoring people through programs like this, through Fox Valley Tech, through Oshkosh, if you got jobs that are hard to fill that require a high degree of technical expertise, I would say you want to find those people now, get them while they're in education and move up. Otherwise, what you're going to have happen is you're going to end up paying up. So, 68% of the United States economy is consumer driven. It's what you and I go out and spend, going out to eat, buy stuff. Who is the biggest impacted by inflation?
The poor.
The consumer and the low income, right? So what's ironic is you have wages going up, yet at this point, inflation is starting to pick up, and eventually, I believe, will catch up and run past wage growth. So, especially with low unemployment. So what you're gonna have happen is, as you raise wages, how many people you think can hold your price points where they are today with the cost of labor going up? Over the next 2 and 3 years, if you're not doing it now, are you gonna pass that along? The answer is yes. You already see that happen. So wage growth over the weekend, the Fed announced it on Saturday, was the highest increase we've seen in 9 years. Everybody's arguing, well, we've talked about it a long time, but it hasn't happened. Trust me, I've got 20 pages of data, you can have all of it, and everything in here says this is happening. And within the room, we all indicated the same issue, right? Wages are the largest component of inflation because it passes through and it affects the consumer. Consumer controls 68% of the economy. Wages are a huge issue. And it's going to cause the next recession. It's not going to be a weak economy, it's going to be inflation. And the Fed is raising rates today. I haven't seen the announcement, but they will. So we go up to a Fed rate now above 2%. And we aren't even close to neutral yet. Fed has another 75 basis points even to get to what I would call neutral rates. They're still accommodative. So we are still in an economy that's stimulating things to grow, and yet we're creating a bubble of inflation. I would argue in the next 3 to 5 years, if you remember the 70s and 80s, not that we'll get up into the low to mid-teens on inflation, but we will get up into high single digits. And that will dramatically impact the economy, and that will be the cause of the next recession. Some people say the next recession is upon us. Absolutely not. There's so much fuel in the engine of the economy right now. We have time. I believe it will be in 2020 within the second or third quarter. Reason for that is earnings are going to start to slow down. Earnings growth last quarter was 17.5%. You've had earnings growth of 28, 23, and 17.5 quarter. Yes, it's slowing down, but at those rates, do we really care that much? It's growing dramatically. So you want the takeaway from today. Here's why this is going to go on longer. And by the way, I saw Janet Yellen on a speech last week. She said exactly this, and thank God, because I felt like I was on an island for a while. She actually said the same thing, which is at this rate, and the fuel in the system, which is cash, we have $16.1 trillion in what's called M2 money supply. That is cash in the system, money market, savings accounts, and most of it's corporate. I was on a conference call not that long ago with Union Pacific. They paid out a big one-time dividend for no other reason that they had so much money they didn't know what to do with, and they paid it out. That leads to, corporately, $16.1 trillion of cash. Do you know what the U.S. economy will spend this year in GDP? Like 17 trillion. So what's great about 16.1 trillion, by the way, anybody know what the mortgages for the country is? The whole country mortgage right now, 10.2 trillion. I can pay off every mortgage in the entire country and still be left with $6 trillion, which is still more money in the savings accounts than we've had in 20 years. Nothing bad comes from cash, in my opinion. Yeah, question?
I have a question. So, productivity per human labor hour is trending down. How do you think automation, increase in wage, how do you think automation will factor into that as companies start investing more and reducing the need for physical labor?
Part of it has been, inflation's already been mitigated greatly over the last 7 years because of that issue. We'd be way ahead of that than we are. You will see that mitigated, and that's partly why, again, I think in historic terms, we would already be at 6-7% Fed rates by now had it not been for that. We've also never seen a stimulative system like we have now, where even after the election, the president still this morning is pushing middle income tax cuts, even though we're going to have $1 trillion deficit this year. That's extremely accommodative. Eventually, it hits a brick wall. So your question is right on, that it will mitigate that and it will take longer for that to play out. The issue, like in my industry, everything I do is electronic. Everything in terms of trading, moving money, all of it's electronic. I haven't seen that much more in terms of my industry added to productivity in the last 5 or 7 years. And there's a lot of industries like that. So again, part of it is, I'd still say a third or more of the industries aren't gaining a lot right now. They can, but it's not happening yet. So we do have to look at today in terms of what's different than normal, but also I've never seen a time with that kind of money. So what do you do with that cash? You spend it. So unless we're turning into the Japanese, who are great savers, which we're really not good at that, it gets spent. So what that means is, the question I keep getting is, why does that number keep going up? Why does cash keep going up? Because you've seen cash flow come from company earnings to be so great, you can't spend it fast. Now, when that slows down, what do? You start tapping into it. And every conference call I'm on for corporate earnings, the question comes up every single time. What are you going to do with that money? And, as a shareholder, I don't want you sitting on all that cash. Like, we're trying, we're raising our dividends, we're buying back stock. Also, the number of publicly traded companies has been cut by 30% over the last 10 years with all the mergers and acquisitions. Our company's going private. So you've got a lot more money chasing a lot fewer stocks with a lot few shares out there. And it just allows this to go on a little longer than people expect. Trends always last longer than you expect. And we're in one of those cases where I think this can go 2, 3 more years. What that means to you is, prepare for inflationary issues in your business. Prepare for an economy that still has a lot of room to grow, but is facing some headwinds. And if particularly you do a lot of business overseas, hopefully the dollar lets up on you and you'll be able to, play better. But the biggest issue, though, is just that we're aware that these things are coming. And the other part about it is we have people give you a couple things on the market. If you want to put money to work, and here's part of why this presentation I'm going to do is we're going to do. So say I got a bunch of money, what do I do with it right now? By the way, the market today is within 4% of its all-time high. So we're down 10%. Give me a week later, we come all the way back, almost all the way. If I got cash, what do I do with it, right? We'll talk about that. So in the public markets, I will tell you right now the 3 things I would buy. There's only 3. 1, any equities, it's emerging markets, reason for that, PE of 10, hampered by the US dollar rising. So most emerging markets, indexes, company stocks, trading in US dollars, have a negative return this year anywhere from 5 to 15%, most of that being caused by the dollar strength. Not by company performance or stock price, it's the movement of the dollar. Emerging markets is coming out of a very difficult financial time. When we went through 2, we came out of a lot quicker. Emerging markets, there's a lot of opportunity, a lot of demographics, and a lot of ability for stocks trading at a 10 PE to get a lot better a lot sooner. Fixed income, everybody's clogging the short end of the yield curve. Everybody's going ultra short. Bad place to be. The reason why, when the Fed raises rates, where does it go? Short end. We are almost on a flat yield curve. I'll send it around. This is the 3-month to the 30-year, right? The 10-year Treasury today is 3.05. The 30-year Treasury today is 3.19. So I had to go up 20 more years and I pick up 14, 15 basis points. What it means is you keep rising rates, the Fed controls the short end of the curve. You're going to end up with the curve being flat or inverted. You do not want to be on the short end of the curve. So everybody, if you're buying bonds, you're buying bonds short. I would not do that. I would buy 2 to 7 years. And the other place to buy right now, buy municipal bonds. Why? Anybody know what's coming with the tax cuts? How many in this room thinks they get a tax cut this year? while yes is in this room, nobody in this room gets a tax cut because they tightened up on exemptions. So did you know that you do not get credit on your federal taxes for 2018 for the state income tax you pay? And they tightened up deductions. In my business, you used to be able to deduct advisory fees, can't do it, and you've doubled down on the standard exemption. So most people today probably do the standard exemption. What that means is that now, in a tax cut environment where I'm supposed to have a lower tax bracket, I'm not going to. And now people that thought they would be at the bracket they're in or lower may actually go up. This is particularly bad in states like New York, New Jersey, California, the really high income tax states. Municipal bonds look extraordinarily attractive in that environment. Anything in the muni space, 2 to 10 year, I think is extremely attractive. It's going to be a crowded trade because people are going to start figuring out, I need to lower my income. People that maybe muni didn't make sense to before, it makes sense now. And the other one is you don't think about it a lot, but in an environment of inflation, what's the purest hedge against inflation? Commodities, and to me, one of the safest way to play commodities, anybody ever hear of MLPs, Master Limited Partnerships? Oil pipelines, that's all they do. You own an oil pipeline, you rent it, but the upside is that you contract with the oil company based on oil prices, so when oil prices go up, my rent goes up. Also, in an inflationary environment, eventually commodity prices increase. MLPs is a way to play it with about half the volatility, and you get a little bit of sensitivity because what you receive goes up with rising oil prices. MLPs are very attractive at this point. People also think about in this space REITs, real estate investment trusts. Actually, one of the most difficult things to be investing in right now. They're highly levered, and most of them have interest rate bumps throughout their history, so they're going to be highly interest rate sensitive. So the one thing I own none of right now are REITs. So if you lay that economic environment, and we look at cash, what do we do with that? So we'll go dive into the presentation. By the way, any of the economic charts, we put this out on a quarterly basis. I got 20 pages of charts that tell the whole story. You can have it if you want afterwards. So the average person who gets to retirement, I'll tell you what, if most people end up with 50, 60% stocks, 30, 40% bonds and cash, right? And what you have happen there is today, you try to own different asset classes so they don't correlate, right? So that everything doesn't do the same thing at the same time. What you're seeing today is that they do tend to correlate, and frankly, you want everything in the public markets. Because everybody in this room as a business owner, I would bet your biggest asset is not cash, stocks, bonds, it's your business, right? For me, I'm a business owner, and I'm in this business, but I got way more money in my business than I do in the market. So the hard part is, how do I make a transition from that at some point, and how do I make that work? I think you need to look at yourself as an institutional investor for one reason. Institutional investors look at long time horizons, and with everybody in this room, your longevity probably at a minimum is at least 20 to 35 years after retirement. What you see today is, the average male and female are getting up to the upper 70s to 80 years old, and if you retire at 60, 65, you're looking at least 20 plus years of retirement. So at retirement, do you use all of your money all in one time, or do you use part of it over your entire lifetime? I think you need to look at yourself as an institution, and the reason for that is that they do diversify their portfolio. Many institutions, foundations, endowments have as much as 60% in alternatives, and we'll define what an alternative is and how they work. I'm not suggesting for an individual 60% is the number, but it's a number between 0, which most people are at, and 60. The other advantage to today about using alternatives is that they have actually got them to be bite-sized pieces that you and I and the average investor can actually use. 15 years ago, unless you had like $10 million, this space wasn't even worth playing in. Today it actually is. So the reason why, and for most of the people in the room, private equity is how you're owned now. In the light blue, that's returns of private equity 5, 10, 15, and 20 years. Private equity produces superior returns. One of the reasons why is that you're running one business, it's more nimble, you have more opportunity to think long-term, more advantageous. The other part about it is that to get private equity money, you have to be able to produce a premium return, otherwise it's not worth it. The one downside to private equity is illiquidity. Like your business, if you're not publicly traded, you all have stock in your company, it's all illiquid. If you have partners in it, you know, they expect that light blue line because they can't get out at any given time. There are ways to institutionally do private equity. There are also ways to do private equity even amongst yourselves. Has anybody in here raised private equity for your own business? If you haven't, it's pretty easy. There's a lot of experts in the state of Wisconsin that can do it. And it still allows you as a business owner to be able to pick and choose your partners, have control, and have options that allow you to buy people out or whatever. So private equity today is, I think, an underutilized avenue. Because there are a lot of ways to skin the cat in private equity. You can sell non-voting shares. You can sell restricted shares. You can sell options to buy people out. And what you see today is a lot of people have an interest in it because, one, they like you, they like what you do for a business, you're transparent, you can see the upside in it, and they're willing to invest locally to do it. And because, historically, private equity produces superior returns. If I'm a business person, I trust myself to make those calls. So that's why a lot of people that we have as clients are interested in this. So as my job, I help to review deals and okay them and do due diligence on them locally, and then we also do stuff that's more national. So private equity, to me, I think we're about 10 to 15 years behind the coast. So especially in Silicon Valley, half the deals that go public have been in private equity and gone this path for 15 years. Facebook's a perfect example. There were thousands of shareholders of Facebook through private equity offerings until they went public. And basically every tech holding today of any size started out as a local private equity offering to move up. So in the state of Wisconsin, it's actually fairly simple to do. And depending on the size of the offering, if you have to go and file with the Fed or not that difficult to do. And you can set the terms basically as long as it's ethical and not overwhelmingly in your favor, you can do about anything you want as long as the other party agrees.
Is it also true then that if you form your own private equity and roll your current company into that,
Yep.
that you're just paying capital gains rates, not S Corp or C Corp rates?
Right. In the private equity, depending on what you're trying to accomplish, usually a limited partnership or a C Corp, we've tended to like C Corps. Let me tell you why. The part of the LLC thing most people don't think about is as you're building a business and generating income or profit and you're trying to keep it and reinvest, as an LLC, that passes through all the shareholders and then they're going to pay tax on phantom income. So if we have a lot of upside we believe is early on and we're going to reinvest, we'd rather be a C Corp than have the shareholders pass through. But it depends on the entity, but yes, that would be correct. So part of it, the discussion is going to be just for you as a current business holder, is private equity a way to go rather than additional debt or dealing with banks? Especially if you have a partner or a group of people that can help you grow your business, drive your business, provide advice, provide new customers. This isn't a bad way to go. And frankly, today, private equity is also taking out companies left and right. You see all these public companies getting bought out. It's being bought out by this. So one of the other things you do hear a lot about is hedge funds. So a hedge fund, if you don't know a lot about them, it sounds risky. A hedge fund is honestly, if it's used right, is actually way less risk than anything else you do. A hedge fund is there to reduce your volatility, to reduce risk. And frankly, in this environment where the stock markets are where they're at, a hedge product or a hedge fund makes a lot of sense because what they're trying to do is generate a return in a different way than the public markets. Let me give you an example. Anybody ever hear of what's called market neutral? Market neutral, their job is to produce a 5 or 6% rate of return every year and do it in a way that is probably 80% less risk than the market. One of my favorites, all they do is long and short equity. So they'll go pick their best stocks, they'll short a company that is like that in the same industry, so the volatility neutralizes it and they're gonna get paid for making the right pick. In an environment where the stock market peaks out, you can still make money in a hedge strategy where if you're long the stock or own the stock, you're gonna ride the downward pressure, right? A hedge fund and a hedge product allows you to maintain your long or equity exposure and reduce your risk. Hedge fund as a term is way too broad and people assimilate that or associate that with things that are very risky. A pure hedge fund is there to reduce risk. And there isn't probably a better time for a hedge fund than right now. Because I want to maintain my stock positions and I know the risk of my stock portfolio is increasing the further it goes. This is my insurance policy to allow that to happen because if something unexpected hits me, my portfolio isn't going to crater, I own that to back me up. This is my insurance policy to continue to be in the market at the rate that I am. Most people aren't aware of these, and today the good news is there are actually mutual funds available that do this work. You don't have to go tie your money up for 10 years or put $1 million in it. You can put $5,000 in it. There are mutual funds that do it. My favorite is it's out of Kansas City. It's American Century Market Neutral. That guy has earned 4% every year for the last like 5 years. And he just continues to just plod along. And he's done that even in a good market. In a bad market, what usually happened in the month of October, he was actually up slightly in a market that was down 10%. His job was to hedge market volatility. Another area of opportunity. So again, what I'm telling you is that the public markets over the next 3 and 5 years may be more challenging if you do have liquidity events in there and you got to have your portfolio generate return for your livelihood. You do have to think differently, in my opinion. One of those things is commodities. Here's one of the reasons why. On the left-hand side, you can see that blue diamond. That is the current price of those commodities. The middle there is the average, and then the highs. Almost every asset is below average or way below average for commodities. Why? We haven't been in an inflationary environment. When inflation comes and we have demand that picks up and we have fewer things being produced, commodities are a great place to go. They produce income in some cases and they just react differently. Now, my suggestion, you go out there and build an option portfolio of commodity futures. Absolutely not. You can buy a mutual fund or an exchange traded fund or even an index fund that give you exposure to that. So again, 10 years ago, these things didn't exist. Today, if I want to hedge my portfolio with commodity exposure, you can do it. There's even a fund that's ticker is GLD, gold. It's a gold fund. Every dollar that goes in, they have a gold bar sitting in a safe. It's direct exposure to gold, and now I can buy an ETF that I can buy and sell every minute of the day. So these are asset classes that are available on a trading platform on any given day. So these are accessible, and these are things you can implement with it. Also, what you see for gold, and then you see on commodity prices, they are directly correlated to inflation. So if I'm riding on inflation, this one's really easy, right? If you own commodities now, and frankly, we started buying them late last year into this year. It was early, they haven't done much. Am I wrong? No. Am I gonna be right? Guarantee I'm right. I just don't know exactly when. If inflation keeps going, this is gonna happen. So what we're suggesting again is looking at what's happening around us and being realistic about it, saying I don't have to have my timing perfect, I just have to be on the right track going the right way. This one's easy. Commodities are gonna go up, inflation's gonna be there, owning some commodities in your portfolio makes a lot of sense.
One of the things you're not addressing in these is tax advantages from these other asset types that you can, is there any one that's stronger or better than the other?
Individual MLPs are tremendous. You get to write off, they can take care of, you get some of the drilling issues come out. If you own an MLP directly, then yes, you do get tax preferred income. So an MLP is tremendously helpful. Now, you can buy an MLP fund, that doesn't happen, you have to buy the MLP directly. If you do that, yes, it's tax advantage income, it will help a great deal.
And municipal bonds.
And municipal bonds. You can get stuff in REITs, I wouldn't own a REIT right now. There is stuff, we'll talk about private real estate, we have been very active at that. And again, with private real estate, by owning single properties that you're renting out and returning income, you can write off your expenses in that up front. So the first usually 2 or 3 years of cash flow is not taxed. And that's set up as a partnership too, so it allows for that. We talked about illiquidity, and one of the main reasons why private equity is worth what it's worth is that you're married, not just dating, right? If I'm doing private equity, I'm in. I'm in for a long time, but also with that, I expect premium returns. And even in the institutional world, they've delivered significantly superior returns. And funny part is, does anybody in the room besides your own business have any exposure to private equity? Everybody in the room should have some exposure to it, probably. And the reason why is that most people aren't in the world of thinking about these alternative assets as things that are normal. I mean, when we think about investing money, we think about stocks, bonds, and cash. Well, how do you make money? You make money with inefficiencies and going against the crowded trade. Right now, money still goes into bonds, even though bonds are where they're at. Cash is now paying at least close to 1.7 to 2%, so it's more viable, and everybody still buys stocks. All that money going that way, that's a crowded trade. Is that the most optimum place for returns at this point? I would say no. So in here too, I'm also recognizing that there are issues with private equity. We can talk about that. But what's been mitigated today is that you can actually buy private equity funds put up by large private equity providers that you have to hold for 1 year, and after that, they allow you to get out quarterly. The biggest thing on private equity is this lack of options. In these big funds, they actually now, you maybe only have to tie it up for 12 to 18 months at a minimum, and then have access out, but provide real liquidity at given points. So the market today, in terms of providing product, is providing some backup to the problems that these assets have. Also, the big thing is going to be, it says $1 million, because yeah, private equity 10 years ago, that's what it took. We've seen deals on even local stuff that you can get in private equity deals for $50,000 minimum. So the biggest thing is, how do you do it? For most people, the way to do it is to do it through an institutional product. So we talk about that. I mean, we've got people that we work with that do some of this product and then also are involved in local deals. How do you mitigate some of those things? For private, there's primary, which is going directly and investing directly in the company. One of those was here locally, if you remember Mills Fleet Farm. Family sold the company to a private equity deal, and there's actually a lot of people locally that are able to invest right alongside and buy part of that. That'd be a primary. Secondary would be if you have it and then you buy it from someone else. So you can provide liquidity, but they're private deals. You got to find the person that owns it, and you got to negotiate a deal. There are some private equity exchanges today that allow that. So a lot of institutions play in the secondary market. They're out trying to buy these things midstream from somebody who wants to get out. Used to be a really cheap way to do it. Today, it's such a developed market that the discounts aren't as big as they used to be. When this first started 15 years ago, I could go in and pay 50 cents on the dollar for somebody that was only halfway through a deal that needed to get out. Today, you might get a 10 to 15% discount instead of 50. And then co-invest or direct, again, that's going to be hooking up with other investment groups to go directly in. So there's lots of ways to do it, and there's lots of ways to get in. So it isn't a cookie cutter. Private equity is it is what you want it to be, and there's a lot of ways to play in the space. And the biggest way, again, to build a portfolio is that each one of these direct co-invests have different risks and different issues. You can easily build a portfolio using these kinds of things. Again, we like using a fund to build a base of it. There's a fund called Pantheon that is American Mutual Fund Group. It's one of the largest conglomerators of funds. Pantheon's been a 25-year-old private equity firm. They did a registered fund, which for $100,000 I can get in the fund, I'm locked up for a year, and I can get out quarterly. The fund's been open 2 years. Last year the fund was up 27%.
What do they charge for management fees and kind of that?
On that one, they don't have a carry. Usually you get 2 and 20, 2% management fee, 20% of the backside profit after you've met a certain hurdle rate. That's not unusual. This fund, though, it's 1% and no carry. So again, this is also an expensive space because the due diligence and work and actually the management teams in direct investments are involved in the day-to-day. There's actually several firms we work with out of Milwaukee who are direct investors. One in Milwaukee, they pretty much limit themselves to biotech, healthcare, and technology investing. And when they buy a company and you have money in their fund, I mean, they're actually involved in management. In a Pantheon deal, they're just providing capital. But again, there are avenues and ways to play in the space without having to own single companies, give up liquidity. There are ways to get at it. So we're just trying to highlight that there are ways to do it. The other thing that happens in private equity, it's called the J-curve. J-curve means when they put the money in a company, what happens normally, right? You're in an investment period. So the value of the company usually actually goes down. So it's hard when you put money in and all of a sudden the first 4 or 5 years, you're losing money. These funds that you do smooth that out. Because then again, it's difficult to be in a 10, 15-year investment and have the first half of it be negative. That's not unusual, but if you can build a fund and buy multiple things that have secondaries or things that are a bit more mature, you eliminate that. And it doesn't sound like a big deal, but if you're in private equity and all you're getting is quarterly or annual statements that show negative, 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 you start to lose a little faith in it, because even though you know the story and why, investment mistakes are made due to psychology. And every time we would buy secondaries is because the investor was seeing this, right? And they said, well, I wasn't making any money, and they'd sell it right here, and I'd buy it and it'd go right up because they'd already been through the difficult part. So investment mistakes normally are made when you look at things wrong. That's why we address the J-curve issue, is that there are ways to avoid it, and it's mostly psychological. It allows you to have multiple things in your portfolio, and you don't worry about that. So also alternatives, I focus a lot on private equity because I make this room get private equity. That's the world we live in every day. There are ways to buy other companies in that way, and then you're not relying on the stock market going up or down. You're relying on the company executing their business plan and making money. There's also a lot of other ways to go at alternatives, and we've listed a ton of them there. All of these things are different ways to skin the cat. They all are ways to put money to work that don't necessarily rely on the market. One of the favorite, again, is private real estate. It's part of the market that's a little long in the tooth. But coming out of the recession, there was huge opportunities in that. there were a lot of people that were selling buildings they had on long-term leases. So we have a number of buildings locally where they had a corporate parent, they sold the building, they have a 20-year lease, we have a set rate. We put in some capital, we provide some debt financing to it, and we can pull out 7-8% annually in terms of yield. We're now on the back end of that where we're selling these, and on all of them, we have had between 13 and 15% returns annualized over the last 5 to 7 years. Can I get that in a REIT in that time frame? No. But I own a building, so the one thing is I gave up liquidity for more upside in cash flow. Now the problem with that trade is I'm telling you that trade ran its course. There aren't any of those around. It's a crowded trade. Everyone was looking for that stuff. Going back to everybody here, people leasing out like Walgreens and CVS stores. You know, right after the Great Recession, 08, 09, 10, there was a lot of that going on, and if you were buying it, you got good bargains. Today, the bargains are gone, and everyone's chasing the same stuff. But that was one way you could get 7-8% monthly cash flow when the bond market was paying zero, when money markets paid zero, and allowed you to, one, know the property, know the building, because you see it, drive by it, you know what you're getting. And then when rates go up and interest picks up, you're able to get out. And so we were able to sell the buildings we bought for 30 to 50% premiums from where we bought it at, and allow it to annualize out at 14%. Unfortunately, that trade's not there for me anymore. Now I gotta find other things to do. But when you think differently and look at the world as an investment opportunity, all these kinds of things are available. Yet as an investor, most of the time, we look at if I'm gonna buy Amazon stock today or not. Which, by the way, I would buy Amazon stock, but it's not your, you know, I'm saying there's a lot of other things you can do. And thinking outside of that box. And all of these things are ways in which you can skin the cat. The other thing about it today is that these are now available as traditional access points, funds, mutual funds, ETFs. There is availability to get into this stuff without having to put up millions of dollars. So how do we look at that? So from investment and private, you do have different things to worry about because you are controlling where you own things, what you own. So the year in which you buy it at matters. If you have a manager, it matters. The stage in which they're at matters. The strategy of the business and the geography matter. So as you look at a portfolio and build it, you have to think about that. And we've broken it down on private investments to 3 primary categories: real estate, private equity, and commodities. And then from there, broke it down by the different kinds of strategies you can use. And a lot of them on there just depend on where you are in the cycle. There's some things on that list I would do now, there's some things on there I would not do now. But there are so many different things out there that, I mean, most of us don't have exposure to or talk about a lot. That's what we wanted to bring to it. And then from a hedging standpoint, we provided 4 different ways in which you can hedge the portfolio. Each of these is a different strategy. So if you're familiar with like large cap, mid cap, small cap, growth, value, this is that within the hedge fund universe. So you can do it by opportunistic, enhanced fixed income, absolute return, and tactical. There are actually mutual funds that allow you to play in all those. There's actually mutual funds that take all of them and manage it for you and put it together. So you could go buy one fund and get exposure to that. In terms of this, one of the great funds to do, you may hear of the firm PIMCO. Probably the largest bond manager in the country. Bill Gross, you know the name, ran it for years. He left there several years ago. But they have a fund called All Asset. And then there's one called All Asset, All Authority. They basically take this universe and buy all of it. And the fee on it's like 75 basis points. So there's one simple fund I use as an example. There's lots of them, but that's one that you'll let the manager decide where they're going to go, what they want to do, and give you exposure to some of those kinds of things. So why hedge? It's about reducing volatility. And we can talk a lot about volatility because look where we've been the last 45 days. And this is nothing. I remember 08. 08, the market was down 37%. How many people in the room feel like handling a down 37 again? I don't think that's gonna happen, but anytime that could. One way you can do it is only have a part of your portfolio exposed to that. And then if you use things like this, again, this adds a 30% buffer to that. And in terms of return, you can see here at the end, it doesn't actually impact return that much. The reason why is that when we have that kind of volatility, we get emotional. I can tell you stories about clients we've worked with and people we've had that get sucked in by the devil, right? There's two devils, there's greed and fear. Today, it's a little bit of both, believe it or not. But both are wrong and both cause mistakes. All you need to do in a portfolio is get you to stay whatever course you want, stay there. And a hedge portfolio allows you to dampen the volatility, give you exposure to stuff you need to get the return, but allow us to live another day. I've done this my entire career. I'm on my 26th year. You think I can handle that volatility emotionally? I struggle with it. I have to tell myself not to overreact all the time. And part of it is when you set up a structure where you have that cushion, it allows you to do that. And so there aren't a lot of other ways to do it. You can either just sell up for fixed income or you look at some alternatives and ways to enhance it. With a market and earnings peaking out at some point, alternatives are going to be a great place to look at. Also, the reason why to look at alternatives haven't done squat in 8 years because the market's been straight up. So everybody's ignoring it today. I think that's a mistake. So with that, we've left time for questions. You can go anywhere you want on the economy, on this stuff, on private equity. Yes?
If you talk to a traditional fund manager, they will say, fixed equity, this balance, going to index, and everything will be fine. Okay, so, and say you have a 10, 15, 20-year time horizon, and you follow that argument. And then you look at your argument of mixing in some alternatives with that. What's your sense of performance differential?
Well, let me tell you why I say this is because most people can't handle a down 37. If you could ride out an index and the volatility that it has in a downtime and not do a thing, it works. My experience in my career is that people can't. So this setup is there more for psychological, right? If you will get better returns. If you buy equities and stay with them and never change, you will be a winner. I would bet 8 out of 10 people can't do that. Because now, especially as you get later in your career, you're talking real money in the market, right? You're talking large dollars, and 37% down is a lot of money. Most people don't have the psychological wherewithal and makeup to stick it out. And also, if you look at it, when you do a plan, do you need to get the optimum return, or should you be taking the least amount of risk you need to produce the return that you need? We do financial planning in great depth for people all the time. And what we find out, people that have done the job, spent less than they made, built up some money, all they got to do is probably earn a 5 or 6% rate of return, and they will never spend through their money in their lifetime. So if that's my goal, I don't care if the market did 12. All I care about is I did 6. And I want to produce 6 at the least amount of risk that I can do. So normally that's where it goes. If I'm just chasing return, you're right. You just lay the market out and let it go. But as you're living off a portfolio, my experience has been most people can't live through it.
Well, I think the other argument too is that if you're looking at that time horizon, when you need it, it's down 37.
Yeah.
It's an aging thing, right?
Right. Oh, and look at the baby boomers when they're going to retire. They may drop out here in the next 3 to 5 years again, right at the time this thing hits a brick wall. So also, I'll address the index versus active. I'll tell you right now, here forward, I would not hold any indexes. Reason for it, look at the top 5 holdings in the S&P 500 and look at where they were 3 years ago and where they are now. You want a tech index. and you own all the names that run, they move on market cap, so the best performing stocks become larger positions. And now your largest positions in the index are Amazon, Apple, Google. And when the market runs, yeah, all you gotta do is own an index, and rising tide raises all boats. Today, where I would say there's definitely winners and losers, and huge disparities of return, I think active is the place to be. Active does a better job in choppy and down markets. And indexes, and we use a lot of indexes over the last 10 years, which is a great thing to do. I just don't think I want to own the market weight of all those names that they are now. I mean, do you really want to own 4% of your portfolio right now on Amazon? Not really. I like it. I don't know about the largest position in the portfolio. And then the other top four, Microsoft, Google, Apple, you know, you're talking about 15% of your portfolio in that index being those top 5 stocks. Maybe not a place I want to be now. 10 years ago, yeah, it was a home run. So part of what we're talking about is that the world is different here forward. We've been on a great run. I still think we have a little bit more time, but what we've seen work is not going to work going forward. Because stocks that trade at 25, 30, 35 plus times in the tech and slowing earnings because the economy is slowing down a little bit, what's their potential upside? How much? Not that the companies are bad, it's just a lot of the growth is already baked in the price.
Do you feel that a lot of that margin came from the tax cuts?
Here last year, yeah, I'd say half the bump did.
Yeah, so when you were talking like 27% down to 17, I mean, some of that reflects the tax cut too, so.
It does, and that's partly why the president's back at the podium trying to get more,
Yeah.
which is a huge mistake in my opinion. I think the Fed's already behind raising rates and adding more to it. I mean, the problem we're going to have is deficit. We have a $1 trillion deficit this year.
Also, one other question, would you have a cash position right now?
My cash position today is one of the largest it's ever been. The last time I had a cash position even close to this was in 2007. We got up to 25% at the end of the year, and I actually, for the only time in my career, had a short position in the portfolio. We shorted the entire S&P 500 by 7.5%. That was a different time. That's where, when we looked in mid-07, I liked nothing. I got stuff I like right now, and I don't think we're anywhere close to that. But as we have new clients coming on board in cash, I'm putting very little to work right now. There's so many headwinds that are potentially in front of us. Cash is an investment decision.
Maybe mention too, I mean, all of our clients are unique and everyone has a different asset allocation, but overall in general, when you're talking putting cash to work in emerging markets or commodities or private equity, kind of where you're comfortable with in that asset allocation, on not 60% that you showed.
Of stocks, my foreign position is between 15 and 20% of stocks. I'm way low. Global GDP, US is 55% of the GDP, so I'm not even half of that there. The reason for it is US is a cash cow generating as much money as we are. Why would I take additional political, currency, and economic risks? I don't have to, but there is opportunity there. We went from 0 2.5 years ago foreign to now we're 15, 20. And then normally on alternatives, I wouldn't go more than 20% of your total portfolio.
You're saying all these alternatives summed up together?
Yeah, so you take all the alternatives lumping together, and I wouldn't exceed 20% of your total. That 20% mathematically, you will see the return in standard deviation, the volatility will drop.
Sure.
And it's got to be at least 5, because anything less than 5 mathematically does nothing. So you at least got to add 5% to make it matter.
If you have a 10-year horizon, 15-year horizon, would be in equities pretty much at that point?
Well, I would say the back half of the 15-year horizon could be this stuff. With equities, I mean, if you have 15 years, I would still, depending on how close to your goals are, I mean, you still probably want to be 60, 70% risk assets. Risk assets would be equities and alternatives. And again, I sound negative. I'm actually one of the biggest bulls I know. I just know the bull market's about ready to end. So I'm trying to talk to you about where you need to be in the next 24 months, because this party's going to end. Not like it all blows up, it's just we're not going to get double-digit returns on equities over the next 5 years. be lucky to get 6-8% because we've had so much baked into the last couple.
Can you go back to the commodity slide? What-
Yeah.
You had some pricing on there. What range was that? Was that
From a
over
time frame?
3 years? Yeah, time frame. Was that over 3 years, 4 years? Right there, that slide, on the left-hand side. Or was that, you know what I'm saying?
Yeah, I'm looking for the footnote.
Last 10 years.
Is it 10 years?
C-scores are calculated using the.
10 years.
10 years, interesting.
Yep, so it's a 10-year cycle. And if you think about the last 10 years, inflation's been under 2%.
Yeah.
But now today, if you look at oil, you know, they backed off oil, so now if there's any rise in demand, it will outstrip supply now. It wasn't that way. So I expect, I'm actually bullish on oil and I love MLPs. MLPs, again, are the pipelines you rent to the oil companies. It's a great place to be with half the volatility. And just any of the commodities, what we've done is we've used a commodity basket or a fund to be able to represent that. Because I'm not a commodity expert. I just know commodities do well in rising inflation. So I hire a manager to figure that out for me. Because I'm not playing in that sandbox. And there's lots of great funds that own just a basket of them. You can buy an ETF, an index, active fund, any of those will work.
How would you go about selecting a private equity company to buy into? You know what I mean?
Well, I'm the head of research, and let me tell you how we do it. It requires a lot of travel, because that is a hands-on, you're buying a manager. So we travel and go see them and talk, and I spend usually a day, half day with them, and go over everything. I mean, I go over the balance sheet, talk about strategy. I've been out block properties before, we've talked to ownership of, or management of some of the companies that are in there. We've gone that route because I'm thinking my reputation on putting my clients in that fund. So that's why I'm in New York City a lot, because on something like that, there's no database like Morningstar for a mutual fund. You've got to go out. And frankly, the marketing people, if anybody's in marketing, I apologize. We sell too. I sell every day. But the marketing people lie and tell the story they want to tell. Until you meet the manager, you find out the real deal. So you've got to actively go out and do it, or have an advisor that is actively interviewing people. My favorite story, and I'll tell you how this fits in, and this goes back, what, Kim, 15 years ago? 14 years ago? I met Bernie Madoff. Everybody's talking about Madoff, right? So I'm in New York, we do due diligence. I was told you should go see this guy, the numbers are great. We go in, and here's how we go. We always go in with a list of questions, and here's what I need. Go in, comes in the room, says, I'm not going to give you any of that. It's going to be a short meeting then. I'm sorry. Left the room. Never thought about him again until what, 6, 8 years later. What it tells you, though, is that people weren't doing that. All I had to do was ask the question. I'm not no genius. I just asked the questions. He said no, and I said, okay, thank you. That's what was really discouraging about the Madoff case, is that people weren't doing the hard work. I mean, they were willing to rely on reputation and what they were told. And in the private world, if there's anywhere where there's going to be fraud, it's going to be there. And that's why literally when we go see property, all the private properties we've done, I walk the property. I want to see it. I want to see the deed. I want to see the mortgage. You know, part of my job is to make sure it's real. And we have caught several times some things that we do not find to be right. Any other questions at all? Was this at all helpful? I mean, is this a topic that was interesting? And so anybody that wants charts and that, again, my view on it is relook at your portfolio. It probably has more risk than you want it to have right now. And also take a look at the things that haven't worked the last 5 years. Maybe revisit. Think about them, look at it. And also, I really think the opportunity for you as a business owner is to tap the amount of money that's in there and get a partner and think about private equity. Because, by the way, our group, we actually are the ones that developed and own the arena here in town. So I'm living it. We did a private equity deal to do that arena. So also, private equity is a way to get things done. Normally, in the past 20 years, you would have had the public sector build an arena. Today, the public sector can and won't pay for it. The way what you got to do it is you have to raise capital to do it. And there are lots of avenues for capital, and there's a lot of people out there that are very interested in it. Also, if you haven't done private loans before, There's a lot of need with banking regulation for people to have access to short-term capital that can generate returns of 10 to 15% for loaning money for less than 12 months.
Why is it that you're saying that it's great to invest in private equity, but nobody really wants to be owned by private equity?
Oh, no, I hate to work for private equity. I'm on the ownership side, so oh, no, trust me. And if I got bought by a private equity firm, I'd be out there in 6 months. Because, no, it's a very different deal. But as an investor, you're on the right side of the table. No, I agree. As an employee, I never want to be in private equity deal on the other end. Not usually what I do.
Yeah, we've had companies, they way back come to us looking at how to inject private equity into their own companies.
Yep.
Because they maybe need the equipment or they need something they didn't have the cash. And this was probably.
That's different than a succession plan.
Yes.
So if you're looking for a 3-year exit, and you decide to get married to private equity.
But what we have
last
seen
3
is
years would be a hell.
you can do private debt. It depends on where you are. A lot of times we see it as you have the next generation taking over a family company. So mom and dad need to get bought out, and there's maybe a little bit of a squeeze or some difficulty there. You can get a partner through private equity or private debt, and not institutional, because institutional are nothing but they're going to be tough on you. What I'm telling you is here locally, there's a lot of people that will do private equity. Our clients have capital that they are willing to do private equity deals. And they're not difficult.
Especially business owners.
Yeah, a lot of us.
They light up, they're ready, but they
Right,
understand it.
because they know your business, they probably know you, they're willing to do it, they're not gonna be a pain in the behind. They're just looking to share in your success. And most of the ones we have, I wouldn't take anybody that's difficult. You can pick and choose who it is. But what we try to talk about here locally is there's a lot of people that have an appetite for it that they don't have enough deals to do. So private equity is a
Bring
pretty
it
good.
to them.
Mhm.
And people have a natural fear of it, so a lot of money managers just don't introduce it to their clients.
Well, I appreciate you listening, and if you have any questions, let me know. Thank you.